Welcome to Smart Finance HQ, where we decode the world of smart investing. Today's episode is a game changer for your financial future. Ever dreamed of living off your investments? Well, today, we're diving into the fascinating world of dividend income and how you can make it a reality. Grab a cup of coffee, sit back, and let's embark on this journey together. To truly grasp the concept of living off dividend income, let's start at the foundation: understanding dividends. Dividends are not just a financial term, they're the heartbeat of passive income. They represent your share of a company's profits, a tangible reward for being a shareholder. When a company flourishes and turns a profit, it has several options for using that money. It can reinvest in the business, pay down debts, or distribute a portion of it to shareholders, and that distribution is what we call dividends. Imagine you're a shareholder in a company like Apple. When Apple declares dividends, it's like receiving a paycheck as a thank you note for your investment. This consistent income stream is a key reason why many investors turn to dividend stocks as a cornerstone of their portfolios. Let's dive into some real-world examples. In the dynamic tech industry, Apple has not only been a pioneer in innovation but also in rewarding its shareholders. Since initiating dividends in 2012, Apple's dividend per share has shown a consistent upward trajectory. As of the latest data, Apple's dividend yield is around 0.6%, a testament to its steady growth and investor-friendly approach. Shifting our focus, let's explore the realm of consumer goods. Procter & Gamble, a household name, has not only been delivering everyday products but also steady dividends. With a dividend yield of approximately 2.5%, P&G has become synonymous with reliability and wealth building over time. And then there's the timeless beverage giant, Coca-Cola. With a dividend yield of around 3%, Coca-Cola has been quenching the thirst of income-seeking investors since 1920. That's almost a century of reliable payouts. But for those who seek not just consistency but an illustrious track record, there's a special club known as Dividend Aristocrats. These are companies that have not only paid dividends consistently but have increased them for at least 25 consecutive years. Johnson & Johnson stands tall in this club. With a dividend history spanning over 6 decades, it's not just a healthcare giant, it's a beacon of stability and growth. Now that we've delved into the essence of dividends, let's scrutinize the numbers. How much can you expect the company to give you? This is where the concept of dividend yield comes into play. Dividend yield is a critical metric, calculated by dividing the annual dividend payment by the stock price. It's essentially the return on investment from dividends alone. Generally, a higher yield is more attractive for income-seeking investors. To put this into perspective, let's look at Johnson & Johnson, our reliable dividend aristocrat. With a dividend yield of around 2.5%, this means that for every $100 invested in J&J, you can expect $2.50 in annual dividends. While this might seem modest, these dividends have a compounding effect over time, contributing significantly to your overall returns. But it's not just about individual companies, it's about sectors too. Different industries have different average yields. While technology companies might not traditionally be high yielders, there's a noticeable shift. Take Microsoft, for instance. With a dividend yield of approximately 1.1%, it's not just a growth stock, it's becoming a reliable source of income, offering investors a balance between capital appreciation and dividend income. Now that we've explored the intricacies of dividends, let's transition from understanding to practicality. How much money do you need to invest to live off dividends? It's not a one-size-fits-all answer, but we can certainly craft a personalized strategy. To live off dividends, you need to calculate your annual expenses and then build an investment portfolio that generates enough dividend income to cover those expenses. It's akin to creating your personal financial ecosystem, one where your investments become the bedrock of your financial stability. For example, let's say your annual expenses are $40,000. If you aim for a portfolio with a 4% yield, you'd need an investment of $1 million. This isn't just a random number, it aligns with the 4% rule, a commonly used guideline in financial planning. The idea is that if you can generate a 4% yield from your investments, you can sustainably withdraw that amount annually without depleting your principal. Think of your investment portfolio as a financial engine that generates a steady income stream. The higher the dividend yield and the larger the portfolio, the more income it generates. And the best part? You don't have to touch the principal amount. It's like having your financial cake and eating it too. With the destination in mind, let's talk about the journey. How do you reach that magical investment number and make living off dividends a reality? It's not about luck, it's about having a systematic plan and sticking to it with unwavering discipline. Start by assessing your current financial situation. How much can you realistically invest monthly? What's your risk tolerance? Once you have a clear picture, set a goal for your investment portfolio size. This goal is not just a number, it's your ticket to financial independence. Divide your goal by the number of years you plan to invest. This gives you a clear monthly target. It's like having a roadmap for your financial journey. Stay disciplined, reinvest dividends to harness the power of compounding, and watch your portfolio grow exponentially over time. The magic happens when you allow your money to work for you. Reinvesting dividends is like planting seeds that grow into mighty financial oaks. It's not a sprint, it's a marathon, and your systematic plan is the roadmap that guides you every step of the way. One of the magical elements of dividend investing is the power of compounding. It's not just about the dividends you receive, it's about what you do with those dividends. Reinvesting them can unleash the full potential of compound growth, turning a modest stream of income into a financial juggernaut. Here's how it works. When you reinvest dividends, you're essentially buying more shares of the same stock or fund. As your holdings increase, so does the potential for future dividend income. It's a snowball effect that can significantly amplify your returns over time. Let's break it down with an example. Suppose you have a portfolio with a dividend yield of 4%, and you reinvest those dividends. In the first year, you might receive $4,000 in dividends on a $100,000 investment. By reinvesting that $4,000, your next year's dividends are calculated on a $104,000 investment, and the cycle continues. Over the years, this compounding effect can lead to substantial wealth accumulation. As we wrap up this deep dive into living off dividend income, remember, it's not just a financial goal, it's a journey. With discipline, strategic planning, and a sprinkle of patience, you can turn your investments into a perpetual paycheck. Thanks for joining us at Smart Finance HQ. If you found this information valuable, make sure to subscribe, hit that like button, and stay tuned for more financial wisdom. Until next time, happy investing.